Good evening to one and all present. Now we start with our second summit of the day, the National Finance Summit, managed and organized by the Finance and Investment Cell, Capita. The sub-theme for the event is changing tides of investment trends in emerging markets in the next 25 years. We are looking forward towards a fruitful discussion to help students understand the future of finance in India. Now, I would like Capital to take the summit forward.
Good evening to one and all present here. We are from Capita, the Finance and Investments Club of IIFT Delhi. Capital as a club is responsible for facilitation of development of interest in finance as a viable career option. We are proud to host the National Finance Summit under the aegis of TradeWinds 2022. Our theme for this year's summit is changing tides of investment trends in emerging markets in the next 25 years. As emerging markets are expected to account for the majority of global economic growth over the next 2 decades, we aim to have a fruitful and holistic discussions on how investments will unfold in such economies. Now, I would like to invite our esteemed panelists and moderators to join us on stage. Thank you so much, ma'am and sir. Our guests for today include Ms. Kavita Gandhi, CFO, Equirus Capital. She's on the way. She'll be joining us soon. Mr. Rohit Vadva, Managing Partner, Iifl Wealth Management Limited, and Ms. Meghna Suri, Director, Iifl Wealth Management Limited. Ms. Ayara Shahid, Director, Head of Wealth and Insurance, MobiKwik. Mr. Sudhanshu Shekhar Agrawal, Vice President, HSBC India. And Dr. Shiba Kapil, Professor of Finance and Head of ICCD and Journal Divisions at IIFT Delhi. Moving on, Fintellect is the annual magazine of Capital, and this edition contains winning articles from a national article writing competition on various relevant topics from global minimum taxes to the implications of hawkish Federal Reserve rates. It also provides a brief overview on major financial news that happen around the year. I would like to now request all the guests to launch FinTelect 2022, Capital's annual official magazine.
Thank you.
Now, we are delighted to introduce our moderator for the summit, Dr. Shiba Kapil, Professor of Finance at the Indian Institute of Foreign Trade, Delhi. She has over 24 years of experience in research and academics. Her interest areas are alternative investments, mergers and acquisition, and valuations. She is also currently serving as the head of international collaborations and capacity development and journal divisions and has held several other portfolios. Dr. Shiba Kapil ma'am is also a member of National Assessment and Accreditation Council of India. She has authored several books and cases published in leading global case centers. In 2019, she was felicitated with the Emerald Literary Award, and she is also on the editorial board of several Indian and international peer-reviewed journals. We are glad to have you with us, ma'am. I request you to please address the audience now.
Very good evening to everyone, and welcome all the speakers in today's TradeWinds Conclave, Finance Conclave. See, the theme has been and is right now like where India or the financial sector wants to be in the next 2 decades, if I sum it up or to begin with. See, India is on a very ambitious plan. It wants to be a $10 trillion economy by 2030. And in order to do so, it needs a very inclusive and a sustainable economic growth agenda. The first thing what it requires is minimum 8 to 9% growth rate in the economy on year basis. I'm not saying 10%, so I'm very pessimistic. I'm saying 8 to 9% year-on-year growth. Apart from this, what it requires is a very solid foundation for the physical infrastructure, lot of augmented investment in this segment, lot of growth in the physical infrastructure, so that all sectoral growths can be mapped together, smoothly done in order to achieve this story. Now, as far as the financial sector is concerned, what I understand is this has emerged and will emerge as the most critical contributor in this whole growth story. And what we are looking at, nothing less than 16 to 18% growth rate year-on-year basis from financial sector. Now, when I say this, what do I mean? What I mean is we need to witness enhanced activities in the banking system, non-banking finance companies and NBFCs, alternate investment funds, be it FPI or FDI or private equity or VC funding. What am I trying to say? What I'm saying is there is a huge credit requirement that you're sitting on right now to fulfill a growth agenda that you're looking at. And where do we stand? Huge deficit in the demand and supply of the credit facility, the availability. So what does that mean? It means a good credit growth coming both from the traditional sources like the banking, you need to adequately capitalize them. Along with it, you have alternate lending sources which you need to support, facilitate, and if I'm allowed to use the word, pamper them. And if you do this, you are on the path of, actually achieving the kind of growth story that we are wanting to. Now, this whole sectoral discussion is sitting on a buzzword which you and I are very aware about. I mean, after the COVID, digitization. So that's the reason the fintech is in boom. And if I talk about the same fintech, which was into a disruption phase definition pre-COVID, is right now you're trying to realign it in the system. So whether I say regular technologies, banking technology, insurance technology, or say robo-advisor or your chatbots or payment gateways or your digital payments, or I say even NFTs. So what I'm trying to say is you are looking at emergence of a new value chain in the financial sector. It's not going to be the same again. So I will not take much time, but I'm going to sum up the introduction saying that the beginning theme has to be more financial inclusion and prudence and more growth in the private investment. That is what we require. So I am very, very thankful to all the speakers who are here. And I now hand over the dice to the club guys.
Thank you so much, ma'am, for your insightful words. Now, I would like to invite Punya and Harsh to introduce our esteemed panelists today.
I'm delighted to introduce our panelists from Iifl Wealth Management, Mr. Rohit Wadhwa and Ms. Meghna Suri. Mr. Wadhwa has over 25 years of work experience in the domain of wealth management, fixed income and equity broking. Prior to joining Iifl, he has worked with Sanctum Wealth, RBS Private Banking, City Wealth Advisors, and Dara Shaw in the past. I would also like to introduce Ms. Meghna Suri, Director, Iifl Wealth Management. With an experience of over 20 years in the field, Meghna ma'am has had an illustrious career in the field of finance. She started out in American Express Corporate Bank, post which she worked in Standard Chartered for 9 years as a Director of Private Banking. In 2015, she joined Iifl, wherein she serves as a partner till date. I now invite Rohit sir and Meghna ma'am to please address the audience.
Hi, I'm Meghna. You know, this illustrious long career that we've spoken of, we've been where you are sitting right now. We've all done our studies, our finance, MBA, etc. We were exactly where you are, 20, 25 years. I think I've worked for 20 odd years. And I'm standing here talking to you all. It feels a little weird, but would love to tell you all a little bit more than what you have learned in the books. You guys know as much as from the bookish point of view. We're just here to tell you a little how the practical world is slightly different from what you read, or a little extension of what you read in your books. That's exactly what we're here for. I don't know what we'll contribute in 15-20 minutes, but hope to bring some data points to you, which is why I'm using a presentation. Sometimes the pictorial influences, it helps you understand things a little bit better. Right. To quickly tell you a little bit about our company, who we are, Iifl is a name you may have heard of or seen in some banners, but you should know who we really are. This is what the company is. We are a listed wealth and asset management company. When we say wealth, what it means is we manage wealth of corporates, business houses, individuals, family offices, etc. Along with that, we're a manufacturer. So we are an AMC. We actually manufacture products for these people. So we are advisors and manufacturers both. Along with this, the third thing we also do is ma'am was talking about the need for lending and how credit really helps expand an economy. So we are also a NBFC. We finance, while banks finance on balance sheet, we finance companies where banks don't come into finance. So we are also an NBFC. We are a listed company. We got listed in 2019. We are the largest wealth advisory firm in the country. Purely from the wealth advisory part of it, we manage 2.6 lakh crores of assets, which makes us the largest in India. We have global presence also, but we basically manage global Indian money outside India, which comes a lot to India. Quickly about ownership of our company, we are 65% owned by foreign institutions. That's General Atlantic, Fairfax, and various other foreign institutions. Public holding is about 15%, and all of us employees own about 23% of the company. So that's a little bit about the ownership of our firm. We are an Indian firm, but you could call us an MNC because we are 65% owned by foreign entities. So, a little extension of what ma'am was trying to say. I'm going to just read a few quick facts about the emerging market that you've been speaking about. We've been, sort of the topic of discussion. Some data points here, very, very interesting. The middle class is the biggest USP that the emerging market has. The growing middle class. 25% of that middle class lives in advanced economies, mostly talking about US right now. 40% lives in the BRIC countries, part of which, this is the emerging market space. And the rest of them live in developing countries. Asia represents, by 2030, I know this is a summit for the next 25 years, but, if we come closer, 2030, Asia represents 66% of the world's middle class population. Now, this is a very, very important parameter because the middle class is essentially the growing segment, the consumer segment, the segment which is buying, consuming every day. And that is where the growth is coming from. They're buying electronics, they're buying cars, they're buying homes, they're buying everything. That's thus the need for credit, the credit card boom, the infra boom, the tech boom, the food boom, the clothes boom, everything happens because of the growing middle class. And that's pretty much the USP of the BRIC countries, which we are a part of. By 2030, 70% of China's population could be middle class, consuming about $10 trillion of goods and services. India could be the world's largest middle class consumer segment, surpassing both China and USA. Those are stats that we have taken from the Harvard Business Studies pertaining to the emerging market. By 30, the other part, which is Brazil, Mexico, Pakistan, Indonesia, etc., would contribute only about 100 million people in the middle class segment. This middle class is growing at the rate of, has been growing by about 10% year on year till 1990. Now the growth rate is about 12.5%. In advanced countries, it grows by only 0.5 to 1%, which is a very small part. Which only and globally, other than the advanced countries, grows on an average by 6%, which means that this middle class, which is growing, a significant part of which is in BRIC countries, will contribute hugely to the GDP of these countries. Why do we invest in emerging markets? You would have studied all this. I'll quickly run through this. I won't bore you with this topic too much. For investors, like Iifl as a company also, we have got a lot of FII money into India from an investment perspective, into the equity markets and into the debt markets, right? Why do they come into India? I mean, I'm just giving an India perspective, but it augurs mostly well for the other BRIC countries as well. It's a diversification for them. Okay, they are investing in other economies. India, the emerging countries are diversification. Valuations sometimes are very, very attractive because you get company. India is not a very cheaply valued country anymore. We are a fairly expensive country as far as BRIC countries grow, but you will find pockets of valuations in BRIC countries, in Indonesia, in Vietnam, etc. So these are great opportunities for FIIs to put in money. Alpha potential, alpha, beta, you all have learned. The alpha in the investments comes from investing in value companies that emerging markets offer a lot. Debt market, while this is a challenge in some countries, but there is debt available in many emerging countries like China, also India. It is a challenge, but debt is growing every day. Low levels of public debt in many emerging countries. This particular point may not be very factual today, because China is going through a massive debt crisis because of the Chinese government trying to bail out many real estate companies and banks. So there will be challenges in every part of the economy, but largely availability of debt is now a USP in some emerging countries. Growing middle class, we've spoken about that, and mostly availability of cheap labor. This is a massive gain for us. The labor in advanced countries is very expensive, difficult to afford. Many countries can't, which is why all these companies come to India. Why do they set up factories here? Why do they set up shop here? They take our intellectual benefits, and they look at the cheap labor that we have to offer. That's why India, both from an FDI and FII perspective, all these points augur well. Disadvantages quickly. Foreign exchange risk. Today, I don't know if you all are aware, but rupee has hit the lowest point today ever. So this is always a risk, the foreign exchange risk that you bear when you invest in an emerging country. Tax complexity. Every country brings its own set of complications and tax. India also has a fairly complicated tax structure. FIIs do think twice before coming to India. उनको समझ ही नहीं आता है कि क्या है, मतलब what's going on, the long, short, the dividend, this and that keeps changing all the time. So this sometimes becomes a deterrent factor. Lack of liquidity. What that means is, when they get money into the country and there is some problem like a COVID or some global issue like a Ukraine-Russia war, and they want to pull out money from, the first money they will pull out is from emerging markets. When they do that, most of these assets are illiquid in nature. So how do they take out the money? They have to sell it at a massive discount. So that's where that leads to a lot of price volatility and a lot of high broking fees for them. This is a little discouraging for them. So this lack of liquidity becomes a problem. Difficulty to raise capital. The cost of working capital in India is very high. You see US and all developed countries work on 2-3%, 3.5%, LIBOR linked, etc. But India and emerging countries are in a high interest rate zone because they're high inflation, high population, high interest zone. So cost of working capital is expensive. Governance-wise, some countries go through massive corporate governance issues. We also face the same issue in India. China faces the same problem. That's a challenge. Chances of bankruptcy always there with overpopulated countries, very diversified countries like us. Market inefficiencies, insider trading, speculative trades, these happen a lot because the regulator, no matter how much it tries to control, because of the length and breadth and volume of transactions, this is always a problem that happens in countries like us. Political risk, of course, is there. Government intervention into public sector. Too much of government intervention leads to red tapeism, leads to problems, execution challenges, etc. Rohit, you want? Rohit will speak on a couple of points, then I'll just add on to some stuff.
So the theme of the lecture today was okay. So what are we expecting from the emerging markets over the next 25 years? These days, it's difficult to call out what may happen in the next 5 to 10 years, but we'll still make an attempt to see what could happen over the next 25 years that could make emerging markets an attractive investment destination. So first is frontier technologies. Now, we all know that the third industrial revolution that started in the 1950s was built mostly on technology and electronics. And then the fourth industrial revolution kind of built on that with artificial intelligence and a lot of other stuff, such stuff. What we are now looking at is basically services that are including high speed internet, AI, big data analytics, cloud computing, blockchain, and Internet of Things. So this is the future that most of the emerging economies or markets will have to invest in going forward. Then the second aspect is advanced manufacturing. You see, what happens is that when an economy begins to grow from an emerging toward developed economy, they tend to see manufacturing slip as a percentage of the GDP. Why? Because we see consumption that Meghna briefly alluded to catch on, which means that you're spending more and more on services and less on manufacturing. But in the current scenario that we find ourselves in, where we have seen massive amounts of supply chain issues across the world in the last 2-3 years, thanks to COVID, the emerging economies will have to invest in some of these high-end manufacturing capabilities that will, kind of keep them growing. And you look at, if you look around us, Germany, we all know what happened after World War II. It took them quite some time to kind of build the country up, but Germany is known for its precision, for a lot of manufacturing, especially in automobiles, that continues happening there. So I think those are examples that we should look up to and look at emulating some of that in our own country. And that is, that is also kind of a cycle, because when you are investing in high-end technology, what you're talking about is making sure that people are having adequate skills to impart that, which means that governments will do their bit in kind of, promoting such high-end manufacturing, and that means more investment in R&D. So it's just a cycle that starts and continues, and that just means upliftment for everybody when you start moving from low-end jobs to high-end jobs. That is how economies grow. The trend is already in evidence here. If you look around, we have examples of Malaysia, Vietnam, that are considered manufacturing hubs for electronics. India also has taken cue, and about 2 years back, on the government's effort to launch the PLI scheme has done wonders for the Make in India campaign that the Prime Minister launched 2 years back. And that is again, to promote more and more manufacturing in India. The third is healthcare. Now, COVID that way has been a big eye-opener, and also has thrown a lot of opportunities for every country. Given that we had lockdowns over the last 2 years, what the countries did was, what most countries did was to actually stop non-elective surgeries, which meant that a lot of people went without getting diagnosed for stuff that needs to be caught on early, like pretty much cancer, heart, ailments. And we also saw something that was completely unheard of, which is teleconsulting. I don't think pre-COVID I would have wanted to call up a doctor and tell him what my symptoms were. Doctors are people who feel your pulse. It's not possible to feel somebody's pulse over a VC, but I think we all adapted to that. And so that is here to stay. You will see a lot many GPs now, even though the pandemic has subsided, GPs have continued to, diagnose virtually. We also are going to be seeing, a subdivision of the medical industry, of the healthcare industry, is high-end equipment. Now, as as countries like ourselves move into high-end manufacturing, I think a large part of the manufacturing that happens of such devices worldwide will start moving to emerging economies, and that is good news for us. Finally, moving to insurance and digital finance, ma'am spoke briefly about financial inclusion. My colleague Meghna referred to the burgeoning middle class across these emerging economies. And it's but natural that when more and more people come into vehicle ownership, property ownership, insurance is something that is going to be there, and similarly health insurance. I think insurance something is poised to take off. And of course, digital finance has been a big boom, thanks to DeMon, followed by GST. I mean, it's just amazing that, you know, the need for cash for a large part of the country has actually been obviated. And we're very happy using all sorts of electronic wallets to transact. That way, I mean, UPI has been a big game changer in India. I mean, it's just mind-boggling that the quantum of transactions that happen in the country using those kind of platforms. Now, apart from these main drivers of growth, there are a number of trends that one should watch out for. These are important because these will throw up investment opportunities in the interim. So first is sustainability and resilience. We've seen what climate change has done, whether it was a recent hurricane Ian or whether the devastation caused by the floods in Pakistan. It's clear that climate change is making the world a lot poorer than it already was. And so obviously, we've all read about the movement away from fossil fuels and to more renewable forms of energy. Last year, IFC Washington had done a study where they've actually said that till 2030, there is going to be almost $13 trillion worth of investment opportunities purely in this field that pertains to climate change. And the other is the education and the skills development. COVID again taught us to learn online, not only for children, but even for ourselves. I mean, any course that you needed to upskill yourself is now all available online. That is not going to go away. The focus of emerging market economies on the high-end manufacturing, R&D, means that the STEM is going to be increasingly a part of our curriculum. And the kind of investment that all of these themes require is mind-boggling. And I think this is where the opportunity for emerging market lies. I mean, it's tough to define an emerging market economy. While you may have studied in your classrooms, you may have noted the Wikipedia definition, but The Economist actually describes an emerging market economy as somebody who's not a country who's not too rich, not too poor, and is not too close to foreign investment. And again, in the last 10, 15 years, we've seen a huge change even in the composition of the emerging market economies. So the one index that we all are aware of is the Msci Emerging Market Index. That started off in the 1980s with about 10 countries. Then in the 90s, we added more countries, out of which Portugal and Greece were part of that. And then they got bumped into the developed world market index. On the other hand, we also saw, Sri Lanka and Venezuela doing very well till about a couple of years back. We all know what's happened in Sri Lanka. It's turned out to be a frontier economy. Turkey, is in a bad shape. Last month's inflation number in Turkey was almost like 80-odd%. And if you look at Russia, you all know where it is. So even the composition of the countries that are, would be termed as emerging economies will change. So 25 years is really a long, long time. We really don't know, what happens then. But what we have is some crystal gazing that the Economist Intelligence Unit has done for all of us, and which I thought would be useful to put things in perspective. So in 2020, we've got US, China, Japan, Germany, United Kingdom as the top 5 economies. And you see where Brazil, Mexico, Indonesia, Bangladesh, and Vietnam are. And then if we fast forward to 2050, and if this plays out, then this is what we're looking at. So China replacing US, India moving up, and same is the case with the other emerging economies. Bangladesh, which is considered to be a frontier economy at this juncture, will will get bumped up to be an emerging economy. So, this is as far as the crystal gazing is concerned. I'll let Meghna come in and give you some perspective on India.
I'm sure you guys are all in India. I'm sure many of you will choose to work in India. So we thought we'll focus a little bit more on India and China, the two most talked about emerging economies that FII speak about. This is a quick. This data we picked up from IMF actually, which said, so this is not an internal data, it's just a data that we've taken. Very interesting, if you can just see that slide, it says that India, which is a $3 trillion economy, GDP today, this is 2021, is expected to move up to the third position. It's currently at the sixth position, expected to move on to the third position with $6.3 trillion from a nominal GDP point of view, whereas China, which is somewhere around 17.5, is expected to go up to 33.7. So, and this is a data which we are extrapolating for 2030. So we are not that far away, which is 7 years. And this is the data that IMF has provided. Similarly, from a market capitalization point of view, today India is ranked 5th with 3.2, US being the largest at 45.2, followed by China. But as this progression happens, market capitalization wise, we become only bigger. Quick data point for you all. In continuation with the middle class point I said, and to also talk about ma'am, what she was talking about, the lending, India's lending opportunity. This is a massive opportunity for India in the next 7 to 10 years. Today, the overall, you see, our economy grows when there is more credit available. If there is, banks are giving money, if NBFCs are giving money, small credit is providing money, that's when the economy really grows. Sabko paisa chahiye business karne ke liye. Paisa milega to business chalega. Right? Look, corporates are 67%, retail is 33% today. This is stats as on today. Now you see tier 1, tier 2, tier 3 India. Retail India, look at the population there. 67% is tier 3 India, which has a per capita income of only $1,200. Now look at the growth there. Now most banks and NBFCs focus on tier 1, tier 2. The tier 3 pretty much has money lenders, private lenders, blah, blah, blah. People who really lend at a very, very high rate. But as and when there is more financial intrusion in that sector, that's where the real growth in India will come from. This is a projection for the next, I would say 10 to 15 years. That's the real growth. The credit real growth will come from there. And India will be an insulated economy. We don't need to worry about recession on our own. हम खुद ही इतना consume करेंगे कि हमें बाहर के पैसों की जरूरत नहीं पड़ेगी. Everybody has money, they will buy. That's pretty much happening today. The trend will continue. But we need financial intrusion in the tier 3 segment. This is again a quick stats. This is just 2 years, Jan 20, Jan 22. This is talking about the equity markets. This is an equity market projection. Now, if you see the black sort of trend you see is MSCI India. The golden one that you see, or the yellow one that you see, is MSCI emerging markets. If you see, last 2 years, why we have taken this is last 2 years has been like a 5-year of economy. We've seen the ups, the growth, the downs, thanks to COVID, thanks to the Russia war, and all of that stuff. You see how India has outperformed the MSCI emerging market in the last 2 years. A lot of it has been also pulled down because of China, which has a great weightage on this. The Chinese economy on the equity side has not done well at all, but this is just showing you some kind of projection on where India is positioned today.
So this is just some data on what constitutes the MSCI World, the MSCI Emerging Markets Index, and about 25 countries. I think the large part is weighted towards China, India, Korea, Taiwan. This is how the MSCI Emerging Market Index has performed. Not good reading over a 10-year time period, but it's done very well since 2000. And there's a concept which is called reversion to mean. So if the last 10 years have been bad for the MSCI emerging market. We hope the next 10 years should be good enough. Thank you.
Hello. Thank you, sir. Thank you, ma'am, for your insightful words and helping us understand that why should we invest in the emerging markets. Moving on, I would like to call upon stage Ms. Kavita Gandhi, the CFO of Aquarius Capital. Kavita ma'am was caught up in traffic and hence is a bit late. However, she was watching the live stream and hence knows what is going around here. Mrs. Gandhi is an alumna of the Indian Institute of Management, Ahmedabad. With over 25 years of experience, she is a reputed chartered accountant with expertise in the domain of strategic management, healthcare finance, control and risk management, SAP implementation, and FP&A. Prior to joining Aquarius, she had worked with Shalby Limited, Healthcare Global Enterprise Limited, Torrent Pharmaceuticals Limited, Amanta Healthcare Limited, and Deloitte. Ma'am is a visionary strategist known for delivering consistent results in her domain. We, the students of IIFT, are honored to have you with us and are extremely eager to engage in an insightful session and learn from your experiences. I now invite Kavita ma'am to please address the gathering.
Good evening, everyone. First of all, my apologies for being late. I really badly stuck in traffic, was not aware about this. It will take so much of time. But good part is this team has helped me to see this online streaming. So probably I was at least feel myself connected what was happening over here. Yeah. Fine. Thank you. So Madam Meghna and Sir has explained in a very well manner what is happening in this emerging market and what they visualize. I'm just going further with this topic. Okay. The topic is really interesting. So mouse is here. Topic is really interesting. We all are aware what is emerging market. It's like a country that is growing at a very fast pace in the terms of GDP, and per capita income is considered as an emerging market. BRIC countries are example: Mexico, South Asia, Middle East, etc. And the early stage of going to be emerging market. So World Economic Forum has identified 24 countries as of now as the emerging market. They take 49% of total GDP in last 10 years, 1 decade. 67% of growth of GDP was because of this emerging market. And in 2023, it is expected 84% of total of GDP growth will be because of this emerging market. If we take the near future, near past, in H1 2022, that is first half year of 22, market was of course down, but though emerging market is outperformed the developed advanced economy. Advanced economy market was down by 16%, while emerging market was down by 11%. So that is the history or probably recent past of this company. Going forward, we are talking whether we should go for emerging market or what will happen over a period of 25 years. Before we speak that, let us understand some peculiarities of this market. I am sure you all will agree or probably understand this. Emerging market is by and large influenced by Asian countries since recent past. Asian countries are competitively having a high level of this population. I think 85% of population is over there. So it's like itself is a big consumer. Probably it will not get much affected by this finance turmoil outside this emerging market. By and large, many of these countries in emerging market are owned by government. So government ownership will help in two ways. Number one is the easy to align with corporate policies. At the same time, short-term pressure of profitability will not be there in this market. With this, flip side is we are taking the risk of corruption or maybe bureaucracy. Again, local market, local paying capacity is not very high in emerging market. That fact also we have to keep in mind. If somebody is producing in emerging market, going outside emerging market, probably profitability will be high. Otherwise, it will be restricted profitability. Plus, they have to compete with the local company. Another factors that is recently observed is emerging marketing also started talking about ESG nowadays. They are showing responsibility towards the environment. They are talking about corporate governance, ethics, equality, advisory board kind of thing. So that is going to give us some sustainability to this kind of market. With these peculiarities, we will see what will happen if we go and invest in emerging market over a long horizon. So of course, high return, high growth is there. Still, some of the emerging market is lower valued. One observation is showing that emerging market stocks are 27% low valued as compared to developed market stocks. In the sense of price equity. So still opportunity is there for investment. Diversification, of course, your risk will get diverted the moment we are in emerging market as compared to advanced economy. Again, analysis says 31% time in emerging market behave in a different pattern than this developed market. So again, risk appetite will increase by default, naturally. Population, again, no need to say, we discuss, it's a key driver for consumption in emerging market, holds a high level of population. So probably that will be self-sustained. Recently, we have observed that power is shifting from Western country to Asian countries. Most of the emerging market are in Asian countries. The shifting of power, probably it will become easy for emerging market to develop and sustain. Education, investing market has started investing in education and innovation. Nowadays, many countries are trying very hard to develop their own institute and developing their qualities. Students have started attracting towards Asian countries, Asian institute. One number is saying earlier, I think 10 years back, 28% of total students worldwide were going to US and other developed countries. Now, this percentage is 20%. So again, this emerging market has started attracting education or students also. They have started spending in innovation. 7 emerging market countries out of top 50 are part of innovation index. So there also, and they have started developing local science. This vaccine developed in India also is example of our country's local science. New patent registration are also happening. So these all are going to give sustainability to emerging market for coming future. Reduction on inflation. Earlier, if you have observed, emerging market inflation was much high, maybe up to 70%, 80%. Now it is by and large getting par with other developed country. So probably this all are positive side for investing in emerging market. Yeah, but each time things is a two sides. So when you take the decision, we should not ignore the flip side of the emerging market also. Emerging, what is the flip side? You all are aware. Major risk is political risk. Political stability is very important. If this country's volatile political system is there, or stability is not there, or maybe intervention is there. China is again recent example, this intervention in tech stock or restriction on Alibaba. So this kind of thing will affect the sustainability or future growth of emerging market. Economic stability is another example. Sometimes regular supply of material, labor, or maybe infrastructure. This may not be there. Market regulation, market may not be properly regulated. Monetary policy is not proper mature. This kind of thing is there. Transparency is another risk. Accounting standards are not so developed like US or other developed country. Of course, Indian accounting standards are very good, very, very good. But other countries' situation is not at par. So risk of fraud is there, manipulation, made up of account, everything, each type of risk is there when you analyze this emerging market. Most of the emerging market are highly dependent on debt or some stimulation from developed country. So again, this dependency is there. If interest rate is increased or probably, they will withdraw the stimulus, emerging market currency will, local currency will be in stress if the repayment will start. So that risk is also always they are carrying. Transparency I discussed. And sometimes emerging market is going on over reliance on a single product or single market. Say, for example, complete dependent on China or complete dependent on one product. So their diversification is not there and they are carrying some type of risk. Bypassing of banking channel is getting very common while investing in emerging market nowadays. And that is increasing. Investor goes and directly invest in specific entity or country. So that is increasing a rate. Default ratio is increasing. And we have observed some people have lost the money in recent past. That is because of this. Concept of deglobalization has started. Now, in some countries, people are talking about nationalism or, aggression against migrants is happening. This all may affect negatively to, investment in our emerging market. So this is plus minus both the things. What to do? That is the conscious call whether to go in a long-term market and in long run over a period of 25 years in this market. Of course, we have to take the balance view, long-term view. Have to see our risk appetite. Risk appetite will different for everyone. Identify the percentage of portfolio that can go to this kind of market. Macro factors and country profile is more important than anything else, like regulation in market, maturity of monetary policy, political stability, maturity of government. This kind of thing is more important. And above all, any emerging market will not remain emerging for the lifetime. They have their own life cycle. The moment we realize it is emerging, invest in, and the moment they will start generating revenue, probably going forward, the benefit will not remain there. With increase in income and it remains, production base will shift to some other country. So right time for exit, identification of right time for exit is also equally important when somebody invests in a emerging market. That's all on my side. Any other question or anything? Thanks.
Thank you, ma'am, for helping us understand the advantages and disadvantages of investing in the emerging markets, so that we can know about both the sides of the coin before investing. Next, I would like to call our next panelist, Miss Ayara Shahir, Director Head of Wealth and Insurance in MobiKwik. Ms. Shahir, an alumna of TAPI Institute of Management, Manipal, with over 15 years of experience in the industry. She has a deep understanding of the entire spectrum of investment and insurance products. She currently has the complete ownership of building digital wealth and insurance businesses for MobiKwik. Prior to working at MobiKwik, she worked across various organizations such as Aon, Morgan Stanley, Systematics Group, and ASK Group, where she built an asset book of over $100 plus million. She is the founder of Rofeli Labs, API first SaaS startup in the country in the wealth tech industry. We are honored to have you with us, ma'am, and look forward to an engaging discussion with you. I now invite Ayara, ma'am, to please address the audience. Thank you.
Thank you. Well, I'm part of the digital world now, heading the wealth and insurance business for MobiKwik, but still using paper. I have no presentation, so bear with me. And I would like to make this a dialogue, or maybe having a conversation with you rather than just me telling you about some data points, which of course I've prepared a lot of data points at my end. I'll share on the way, but that would be really helpful, to know your perspectives while we take this conversation ahead. So first of all, thank you so much for giving me this topic, India at 100. Well, I have never thought and never internalized that what India would look like at 100. So it made me research a lot. But then I realized, I guess the average age over here would be about 25. Yes. So you'll all be 50. So you are going to define what India would be at 100. So I think I should ask you, what biggest change you see, when India is at 100 years of its independence. So I would look forward to chatting after the panel discussion. So on 75th anniversary of our independence, I remember that we really celebrated that India has become the 6th largest economy in the world. And just a month later, I think we became the 5th largest because UK decided to kind of, go down instead of be catching up. So you would be, it's a 75 years of journey. We were at 6th largest economy in the world in 1950. And it took us almost 75 years to recover that position back. And we all celebrated, wow, we are back in that position. So it was a good V-shaped recovery, a reason for celebration. But for me, the most important parameter to judge an economy is the per capita income. So we are at a per capita income of $2,200, almost $2,277, which is the bottom quartile in the world. Our position would be 158th in 205 odd countries in the world. So by the virtue of having huge population, we are the 6th largest economy, but we are still poor. That's a reality. We are improving. After $2,000 per capita income, it's considered that our consumption starts moving up, and it's a positive cycle of consumption and investment that again builds the country. Anyone would like to guess what would be Bangladesh per capita income? Anyone? Take a wild guess. Yeah. I'm glad. I thought it would be $1,500. So yeah, I mean, it's $2,500. This is 2021 data as per the World Bank. We compare ourselves to China. China is at $12,000 odd dollars of per capita income, and US is $70,000 per capita income. Even Vietnam, Thailand, Indonesia, they're all much richer than us. So there is a long, long way to go, and we have just started. I would focus more on fintech and finance sector as the area which is going to contribute, which moves 1.5 times faster than the overall economy. Nominal growth of the economy is say 12%, but the finance sector technically or has typically contributed 20% kind of a growth in last few years. And right now we are seeing a revolution going on when it comes to financial inclusion. So the good news is we are the 3rd largest fintech market behind only China and US. We are actually the world leader when it comes to financial or fintech adoption in the world, which is at 87%, while the world is at 64%. The average at the world level is at 64%. We are a hotbed of entrepreneurship in fintech. Another question. Any wild guesses? The number of fintech companies India has seen in last 5-7 years. The new startups. Okay, anyone else? It's 7,441. It's equivalent to number of listed companies we have in India today. That's the level of entrepreneurship we are seeing today in fintech. So fintech is a broad word for a lot of small. There are a lot of sub-segments which in themselves are more than almost reaching $1 trillion in their own market size by the time India touches 2000 whatever, like India at 100. So most of my data points are related to 2030, where we can see, because this is a very nascent industry. And every day things are changing way faster than we expect. It's not a stable industry. There is innovation happening every day. The regulators are also working very hard to manage that innovation, that it does not disrupt the stability of the economy in a way. But I would touch base on the main 5 sub-segments, according to me, which are part of the fintech revolution we are seeing in India. Starting with payments. Payments is the core of an economy. So anything you do, you shop, you invest, you do charity, you invest in India, you invest outside of India, anything you do is payments has to happen. And India is ranked #1 in world in real-time digital payments. None, including US, including China, can do these kind of real-time digital payments, and that's thanks to NPCI. NPCI, UPI is a transformation which India has seen in the last 5 years. It is a record number of UPI transactions we are seeing month on month. 6.28 billion transactions over UPI has happened in the month, in the month of August 2022. And NPCI is all geared up to manage 1 billion transactions in UPI every day. So put things in perspective. Today, 2 out of every 5 transactions which are done in India, excluding large corporate transactions, are done digitally. And it is estimated that by 2026, we would see 2 out of 3 transactions will be done digitally. We are almost on the path of, I'm not saying we'll be completely cashless economy, but certain things like demonetization, UPI, and COVID, there are a lot of people who adopted digital modes because COVID pushed them to do the, handling of cash was a source of infection. So everyone moved on to downloading all those apps which were supporting the digital transactions. While we are at such a large scale we are doing in payments as of now, but there is a huge opportunity still. India still has 35% of inactive bank accounts which were never used. And we see, and if you see, the global average is only 5%. We still have 35% bank accounts in India, and not everyone has bank account, by the way. But whatever we have, 35% people have never used them. So mostly would be Jan Dhan accounts which were recently opened. What's going to change the scenario even further? ONDC is the project which Mr. Nandan Nilekani, our respected Nandan Nilekani, who was behind Aadhaar, is right now working on, which is going to digitize the entire e-commerce, the small e-commerce industry, or the merchants which are doing transactions, and consolidate that. 5G rollout. We already have great mobile penetration in India. And 5G rollout is going to even speed up these things of using low-cost internet and fast-speed internet, even to tier 3. When it comes to financial inclusion, our mobile devices with internet is what it is changing, which is bringing the real financial inclusion. UPI mandate for auto pay. Like we have, eNash, which is what we use, for our EMI payments. We give the instruction to the bank to repetitively take out or deduct our EMIs. UPI is going to support that, which is easier for tier 2, tier 3 people to manage, vis-a-vis managing it directly, going to the bank and setting it up. We have UPI right now from your saving bank's account. NPCI has come up with UPI on credit. So your credit cards today, what you carry, would not be required because your credit cards will get connected to your UPI and it would be similar. So personally, I have reduced my credit card usage drastically because UPI is far more easy. I just carry my phone everywhere. I don't carry cash. I don't carry any cards, nothing, no wallet. So this has been 3 years journey where I have stopped using any other mode of payment. And soft POS machines. You scan the QR code wherever you go. So we used to have machines which were expensive, yet we haven't seen the penetration. But now you have given the POS machine on the mobile of an individual, whichever part of the country he is. So these are the few things which are changing payment industry in fintech. I'll touch upon post this. The biggest opportunity India has is lending, digital lending. So again, India has more than 80% people who are unserved or underserved with credit products. While US has only 17% population which is unserved or underserved with credit products. So it's complete opposite. The reason are many. One is the generation X, our parents, never believed in credit. Credit is a bad word. अपने चादर से ज़्यादा पैर नहीं फैलाने चाहिए, etc., etc. But credit brings a lot of balance, a lot of efficiency in how you manage your money. Credit is not bad. How you manage the credit is important. So there's a lot of innovation that is happening in right kind of credit products. So what we say is new to credit customer, an NTC customer. This is supported by digital lending because banks cannot afford giving 2,000, 5,000 rupees loan instantly. Only technology can do that. Which digital lenders, which are like right now, I think more than 500 in number, are trying to disrupt. Few of the top ones are Off Business, which is doing it to the MSMEs, and followed by we at MobiKwik also, we have our credit business. We call it MobiKwik Zip. That is the BNPL segment. Have you heard of buy now, pay later, insure now, pay later, fly now, pay later? That's what BNPL is. This is one area which is true in bringing the financial inclusion because this product is almost like credit card. Credit card is a physical product, a bank. Again, the cost of giving that credit card, reaching out to the customer is very high. But say somebody sitting into your phone using an app, clicks on credit for MobiKwik Zip, gets even as low as 500 rupees in the Zip wallet or in the credit, and he can use that to buy anything, anywhere, wherever Zip wallet is integrated. This guy who never had a credit history, 0 score on CIBIL, was never given any other credit product because he has no credit history. So it's a chicken and egg story. How do you solve that? You have to bring him in the system. Maybe at a smaller ticket, he will build his credit history, he or she will build his credit history, and then he'll be eligible or she'll be eligible for bigger, higher category loans like home loan, personal loans, education loan, etc., etc. So that's a real financial inclusion, giving money, smaller money to start with, but when the guy genuinely needs money for his business, he has a credit history at hand. So bringing new to credit customers is the biggest challenge, and that's what the fintech is heavily focused on. So right now, $150 billion is the digital lending market in India in 2022. We expect this to grow to $515 billion by 2030. So that's the kind of growth we see in digital lending. 50% of all retail loans are going to be digital in next 3 to 4 years. The number of loans which are given out, 50% of those loans will be completely digital. What is the biggest disruptor again in digital lending? The AA framework, which is account aggregation. Right now, if you go to the bank or anywhere, and if you have to submit your, your 6 months bank statement, some other proofs. So one is there are digi lockers, which gives the access to the digital lender to access any kind of, or not any, but whatever you give access to the PAN and the KYC data. And AA gives if you give the consent that you can share, you can take my bank account statement using the AA account aggregator ecosystem. So lender does not need anything from you. Convenience. Today I have to put in some kind of effort. Tomorrow it's just giving the consent and the data will be passed on to the lender. That's going to be the UPI moment for digital lending going forward. How many of you have taken a loan in the past or used a credit card? Oh, that's a good number. So tier 1, I can see there is a good penetration. Phenomenal. So you all have started with your credit history and you have civil scores now. I move on to my favorite space in the fintech, which is wealth tech. What brought me here was I was doing wealth management for ultra HNIs, suggesting them where to invest. Beyond a point, I felt that they are overbanked. Everyone wants to serve them. And they have access to advice from their friends. They're very well connected. They're globally connected. They are smart. So they genuinely might or might not need your advice. But the segment at the bottom of the pyramid, if we are looking at financial freedom for billion people in India, it has to be digital. There is no other way. So the challenge I had in 2012, like my cousins would reach out to me and say, where do I invest? And I'll tell them, okay, these 3 mutual funds, invest in for 5 years, do your SIP. But the next question would be, isko karna kaise hai? Kahan jana hai? And I would not have wherewithal to support those executions of, filling up the forms, sending it to camps and Carvi. So DIY platforms came in for execution in 2012 or 14. 14 is the main time, 14 or 15. And it then picked up from there. Then it came to robo-advisory, that even a guy with a 1 lakh salary or 50,000 salary, or even investing like 1,000 rupees a month, needs advice where to invest. There are so many mutual funds. What should be my goal planning? What should be my financial planning? They need advice. So robo-advisory, and execution, seamless execution. The entire KYC done digitally. You don't need to go anywhere, do anything. You can just open within a couple of minutes your account and start investing. The DIY investing platforms, the rise of financial influencers. The problem was education as well. Now, robo-advisory also still does not personalize the advice. It's a very, we say AI, ML, everything is behind it, yet there is no AI, ML. So, and our millennial generation took it in their own hands. We want to study, especially COVID, they had a lot of time. So when they had time and they started investing that time in learning where to invest, this was one of the, again, transformative moment for wealth industry, where a lot of influencers picked up and they started giving financial advice online on small. So you have Rachna Ranade, one of the biggest financial influencer, Finance with Sharan, and many others. So these started giving out the nuggets of wisdom, how and where to invest, which started solving problem of just then you are left with only execution. Even YouTube became a big education medium, right? So then it brought in new to wealth and new to investment customers who were never investing. The second biggest trend is consumer behavior. So millennials, which is like people who are born, you all are millennials, I would say. They're born after 1982 or even till 2000 are the guys who are considered to be millennials. They're the biggest bet India has. 34% of our working population is going to be millennials. They are earning more and they're investing at an early stage. We used to, our average age of starting the investment was 26, 28, they started investing at 21. And the avenues of earning initially were certain jobs, but right now even gig economy has given a lot of thrust. Even at 18 years old, an 18-year-old guy would be earning in lakh just by being an influencer, a fashion influencer, or maybe giving some kind of coaching to somebody. So the avenues of earning has improved. The net national disposable income has risen. And their risk appetite has improved. They do not want to invest in RDs, FDs. They want to take, they understand inflation and they want to take risk and higher returns. So crypto, NFTs, P2P lending. P2P lending has become a big asset class amongst the retail digital new to wealth or new to investment guys. So wealth tech is another huge opportunity. Only 3.7% of the Indian population invest in the market today. In US, it is 55%. A long way to go. So what I see is that through wealth tech, there is $20 billion AUM as of now, which is expected to go to $237 billion by 2030. That is almost 10x. Huge thrust of growth. Followed by neo-banking. Neo-banking is, anyone has a neobank account? Oh, okay, that's okay. So banking is very intrusive. Like, somebody will come to your home, or for a lot of things you have to go to the bank. Neobanks said, why? Everything is available. We can use technology. They are tech-first companies. They are not really banking companies. They are digital only. There is no retail shop or outlet they would have, or presence they would have, physical presence they would have. So they are right now not given license by RBI. So they are partnered with traditional banks. They are using the rails of the traditional banks, which is Federal Bank, ICICI. They are one of the guys who are participating in the neo-banking channel. So now neobank is like just bank with a better technology. Because bank is not able to really upgrade their technology. They are huge and it's not easy. And they're not tech first. Their DNA is not tech. So neobanks found the opportunity that here I can personalize the advice on the bank. I can personalize even saving rate. Why not? Then I can, even on the credit products, they can have small bite-sized products. Insurance, they can work on the small bite-sized insurance. So neobanks is the next area of growth which fintech is betting upon. So in India, there are 24 plus funded neobanks. Few of them are Jupiter, Phi, Neo, and Razorpay has recently entered for merchants. The last is insurance, insurtech. So insurance penetration in India is only 4.2%, out of which life insurance takes 3.2%, 1% is general. And in general, motor insurance is a mandatory insurance by government, so everyone has to take it. Rest others are almost negligible. Health is a very fast growing segment because healthcare is becoming very expensive. You cannot go to a government hospital if you are, even a lower middle class person. And the only way to afford a private hospital is have an insurance. So we are going a US way when it comes to healthcare in India. So insurance will be untouchable beyond a point if you don't have insurance. So health is one big segment. There's a lot of innovation is happening in insurance by insurers, as well as regulators also opening up a bit. So we have toffee insurance kind of things, which are small ticket insurance. We don't need to. One interesting use case is embedded insurance. So earlier, if you have to buy insurance, we'll go to the insurer. Now, wherever you're doing any kind of consumption, you are transacting online, they'll sell you the fraud insurance, online fraud insurance. If you're buying any kind of washing machine or anything, so Amazon will have an embedded that you can insure with phone. You get insurance. So Ola or anyone who has a product or service, they're embedding the insurance within that, the relevant insurance. So that's one of the biggest trend which we'll see in insurance. It's by the technology which insurer companies have built as an APIs, which these guys can consume, and then you can embed it and give it to the consumer. So, to conclude, I see India at a global stage as a mid-cap stock. I've spent a lot of time in ASK, so Bharat Bhai has a philosophy of 4 ways of identifying a stock. One is the quality of business. So the quality of India is very good. We are hugely benefiting out of our demographic dividend, and for next 20 years we will benefit out of it. We are ambitious, and we have a good education in comparison to the global education standards. When it comes to earning growth, I think we are one of the fastest growing economy in the world, and we continue to be the fastest growing economy in the world. So our earning growths are intact. Then it's the size of the opportunity. I just talked about size of the opportunity in every bits and pieces where it comes to where do we find the size, and then it is value unlocking. So India has reached here with its agriculture and services business. Manufacturing is completely locked, I would say. It's going to get unlocked. So in next 25 years, India would definitely surpass, I wouldn't say it will surpass China, but it will be the 3rd largest economy. And I would be really happy to see, or I would bet that India would be at $7,500 per capita income, at least upper middle class in the next 10 years. That's what I conclude my speech with. Thank you.
Thank you so much, ma'am, for your insights on the fintech sector and how it will lay out in the next 25 years for India. Our next panelist is Mr. Sudhanshu Shekhar Agarwal, Vice President, HSBC International Business Banking. With over 7 years in the industry, Sudhanshu sir is an alumnus of IIFT Delhi, batch of 2014. The majority of his work experience lies in the corporate banking domain, and he currently looks after the liability and asset banking requirements of over 70 corporations. Prior to joining HSBC, he has worked in companies like Yes Bank, RateGain, Expedia Group, Triton Group, and Sav Miller. I would like to invite Sudhanshu sir to please address the audience.
Hi, thank you. Thank you for this amazing introduction. Firstly, I would like to thank my teachers, my professors. We are here only because of you. We've been able to build a career out of these walls. I still remember that used to be one of my favorite areas of sitting, because you never need to be in the direct speaker's point of view, but still you could look at your phone sometimes. So I remember that. And I don't know, I feel so honored to be part of this panel. It's such a learning experience for me, and I hope I can guide you for some of the recent experiences which I get just out of college. So if I don't have a presentation, it's impossible to get a logo approval for HSBC. A presentation in 2 days. The only one I could get is the small logo. I had to take 3 speaker trainings for doing a public training session. So bear with me. I have some data. Most of the data these guys have covered. I would like to be more on the transaction side. From the banker's point of view, we are privy to a lot of transactions happening, right? And which countries are doing it, what kind of companies are doing it. So I would be more from the transaction side of the business. If I talk about myself, I have been, I have banking in my blood. My parents are, one of my parents is a banker. One of my uncle is a banker. So we used to have a lot of banking conversations throughout when I was growing up. So one thing I would like, my 2 cents for you, whenever you go to a corporate world, nothing is small, nothing is big. Even knowing if you go to a bank, if you go to a banking domain, knowing how the check clearing works and knowing how NEFT, IMPS, RTGS, and then UPI works on IMPS as a backbone. These things will help you become a seasoned corporate banker or any kind of a corporate worker. So always try to gauge those small details. It'll help you in your long term. That's something which I felt helped me in my career, my short span of career. With HSBC, I work in the global banking domain. It's a global banking arm which we call international business banking. I am part of the India desk. We have 67 countries, so we have a desk in every country. We connect with each other. What we basically do is we help the MNCs, be it a startup, be it an SME, be it a global big company, to consolidate their banking in these 60 plus countries, right? Because every company is going international today. Trust me when I tell you, every startup in India wants to have an international presence. What they could do in India, they can do it in Indonesia, because it's a very similar demographic. They can do that in even Middle East today. Israel, Saudi, all these things they have a very kind of expertise. Swiggy, Urban Company, these companies are actually replicating the models everywhere in the world. So they need a banker. They need a banker which is present everywhere. Few banks are present everywhere, and that's why the expertise of banker is very crucial today in terms of guiding the corporate on how to handle their transactions. So that's where we come into the play. If I tell you, just to give you a little bit of a terminology. So my terminologies, I may be using FDI in my discussions, but FDI is only the equity instrument that we talk about. A lot of companies are also using CCDs, compulsory convertible debts, debentures, and ECBs, external commercial borrowings, as an instrument to bring money into another country, right? So ECBs have a maturity time which can be converted from debt to equity. So eventually, all these are just ways of bringing money into India. So I may be using FDI as a word, but FDI means other instruments as well, how to bring money into India or any other part of the world. Perfect. So I just have 5 points. I'll keep it very precise, very concise. I wanted to have an engaging session, so I have very two important serious questions for you. I don't know if you would like, anybody would like to answer this, but do we still use Go IIFT Go? Yes. We do. So we if we came up with Wadis, we should use something which is more interesting. And I really like how you guys are actually organizing these fests and events, and we've been following it up. And one of the major things which we come across is in HSBC, a lot of alumni talk a lot about being present in your speaker sessions. So please keep inviting us. Please keep inviting the heads of the global banking piece and all. They feel very proud and they come and tell us this. Thank you for this opportunity again. So coming to the topic, basically, most of my data is from the United Nations Conference of Trade and Development, which we used as students here. So the first topic which we wanted to talk about is comparing the developed versus developing, right? So developing is, so just to give you a little brief, most of the trends before pandemic hit was showing a better CAGR in the developing industries, in the developing countries. There were a lot of positivity where investors, private equities, fund houses, family fund houses were looking to get better returns on their investment. They were starting to feel that the developing countries are now risk-free. So there was better CAGR growth in terms of the investments in developing with comparison to developed. But with the pandemic hitting, again, post-pandemic, the numbers which are coming in, most of the people have again taken a very risk-free approach. Most of the investors have started thinking that we should be actually getting a normal return, but we don't want to be ending up in a Sri Lanka kind of a situation where the economy did go bust for a while. So if I give you a number, 3/4 of the total FDI in the world is again in the developed countries. Only a quarter is coming into the developing countries right now. Comparing 2020 with 21, there has been a good comeback in 21. 200% of the developed countries FDI has come back into the picture, compared to 30% of the developing, which has only been able to come back as only a 30% module of what they were in 2020. The developed countries were majorly able to recover because of USA. USA came up with 114%. But an opportunity which developing countries can see, because the EU, the European Union, and the UK only came up with 8% of their recovery after the pandemic. So this is an opportunity which is created obviously by the war happening, and a lot of companies and investments are not looking to invest in those EU countries. So this is an opportunity which the developing countries now have to gauge, right? Getting those FDIs where obviously the opportunity lies. My second point was to go a little deeper in the developing countries, right? So if you look at the developing countries, who are our major competitors? If you look at as India, who are our major competitors, where the investors are looking to invest more, where the companies are looking to invest more. So again, we talk about China as one of the developing, but it's one of the biggest economies now. So China has come back to 20% of its original value, but the base is very high. So again, China still recovering 20% is a positive thing that still these countries are looked at. Brazil has come up 100% of what it was in 2020 features. India is down by 26%, but that's a temporary thing because a lot of numbers had to be coming in for 2021. We've still not released the complete 2021 numbers, so we're still hoping that we do come out to be something of a recovery of that sort. The South Africa economy has grown 1200%, but that's an outlier, I feel, because I did a little bit of research why South Africa has come in, but the reason I could find majorly is because Naspers and Process is present there, right? One of the biggest investing private equity players and venture capitalist players. So this is something we're learning for us, that we should have more India-based venture capitalists. We should have more India-based private equity players, because that is where the Indian centricity will be developed, right? So we have a lot of founders who are asking for money, but where are the people who are giving us money, right? We don't have that in India. We need to channelize that, make things easier for them to grow, right? We have a lot of wealth in India, right? There are a lot of people who are looking to invest, but why don't we have a good number of channels there? ASEAN has come up 35%, so it's good for the Asia market. One example which comes from my experience here is that post pandemic, one of the largest companies that we have at HSBC India, it's a Netherlands-based company. It is operating in Europe, UK. All of its clientele is in Europe and UK. It's 95% of its employees are India, and it does not have a single office in India. So everybody's working from remote places. We could not think of this 2 years back, right? We could not think of a big company which has a Fortune 1000 listing operating completely on a remote environment, right? They're not investing in offices. They're not investing in expensive UK labor or European labor. They're looking for India as a place where they can have employees too, right? So this is an opportunity for us. Why don't we again go back to our basics, where we were a good outsourcing hub, we were a good technology hub, and we could target those sectors again. There's been a lot of Philippines and Vietnam kind of countries who have kind of come up as competitors for us, but India can target those things again, because post pandemic this is a very good solution for a company which is looking to increase their PAT levels. They're not looking to increase the cost of employees. One more point which I want to touch point is the industries. We know the regular industries, infrastructure, which manufacturing, which are still getting a lot of FDI, a lot of investments. But few industries which have suddenly boomed after COVID and pandemic is the greenfield, renewables, and the sustainable industries. Right now we need to have a solutioning as a country to promote these more in India, right? China is still a manufacturing hub, but it's still diversifying into other fields, right? So we can also look at doing that, and if that is our goal, to get more investments into India in the next 25 is again a very long picture. Even in the next 5-10 years, if you're looking to do that, that should be an industry that we are targeting, one of the industries that should. One of the LinkedIn memes today, I don't know if you guys seen it. This is very close to me and this hurts me very badly. It says, tell me if you guys have seen it. It says the countries which have provided the most startups, and they have 5-10 names where India does not figure. Okay, the countries which have provided the most startups. Then there's a line below, the countries which have provided the most startup founders. And anybody like to take where we are? We are first. Correct. So we as bankers see this a lot. We are very surprised by this, but this is a trend. How many of you would want to go into entrepreneurship at any time? Maybe 5 years down the line, 10 years down the line? Any plans? Right. So just if anybody or all of you can tell me, what would you require for starting a company? Good. Capital. Idea, absolutely. Team.
Ideal working conditions, like safe environment to work.
Perfect. Absolutely. Anything else?
Problem.
Correct. A problem statement for which the idea is. One important point which a lot of startup founders miss out. Or planners, sorry. Startup founders do get that, but the planners miss out. So I sit with a lot of these people and they all tell me that people don't think about a runway. So it's not about the first capital raise. It's also about the first seed funding, the first Series A funding that you guys are looking at. Because money will go out after 1 year, 2 years, because starting is a loss. It's a cost heavy company, right? Cost heavy investment. So that runway, if you're looking, eventually you're looking to, maybe if you're bootstrapped, that's very good. But if you're looking for a seed funding or a raise in the future, you need to have that runway built up for you, right? Now, I'll give you 2 examples. How many, if anybody would like to say, where would you start that company? Which state, which city? Maybe your hometown, yeah? Gurgaon, yeah. Bombay, Bangalore, okay. Maybe your hometown also. If I give you an option, so there are countries like which are 2 hours away. There are countries which are 4 hours away from India. They're calling you guys. You have capital, come set up a company to us. We'll give you a work permit. We'll give you all the resources which required. Give employment to our people. So the countries are Mauritius, Malta, tax havens like Jamaica, British Isles, Singapore also promotes this a lot. So would you still open the company in India if you had that option? I'm happy you're patriotic. But again, a lot of these founders are not doing that. So a lot of these founders, everybody wants to manage the Indian market. They want to have consumers in India, but the holdco, the holding company is based out of Singapore. It's based out of Hong Kong. It's based out of Mauritius. It's based out of Jamaica, because they're giving you tax benefits. The funding raise is very easy there, right? It's a very positive thing for investors, for the venture capitalists of the world. इट्स अ सिंगापुर बेस्ड कंपनी ना, मैं इसको थोड़ा ज्यादा दे दूंगा. इंडिया है यार, हाई रिस्क है jurisdiction, कल को कुछ क्या हो जाए. So that's the outlook which we sit with private equity and venture capitalists, that they say. And company is the same. They're actually dealing in India, they're working with Indian consumers, but they have a holdco based out of Singapore. So this is a trend which is a problem, I feel, which needs to be addressed. We need to be giving a little more of leeway in post compliances for FDI, pre compliances to ECBs, making banking easier for them, getting foreign remittances in very easy for them, and actually making their investments easier, right? Even for them to invest their money outside India should be an easy option for them, right? Nobody wants to invest in fixed deposits or Indian mutual funds also, for that matter, right? So just a small point, the fifth point is now there's a new trend which we've seen with polarization of the world. Now you cannot just be depending and following the US transaction status. You cannot be following only the SWIFT messaging service. You cannot be following the FATF guidelines, right? You cannot be only following the sanction list. Now, if India or these developing countries need to come up, they need to be having a Nostro or a Vostro relationship with Russia. They need to be having a relationship with China. They need to be not polarized into a West versus an East demographic, and that is a new trend which banks are following these days. A lot of Russian banks are reaching out to Indian banks and creating a solution for them so that the Russia-India relationship continues. Even China having a problem with between US and China, there is still a lot of countries which are dealing directly with China now and not being dependent on USD anymore. China is trying to promote RMB, which is one of their currencies as one of the big currencies. Why can't we do that? Why can't we look to do that in the next 25 years? Sorry, this is a little far-fetched, but since 25 years is the goal, so I thought I'll bring up a few points which, if we start today, why can't we achieve that in the next 25 years? And absolutely, you guys are the future. And thank you for this opportunity again, and it's been a great pleasure for me. Thank you.
Thank you, sir, for helping us understand the trends from the banking side of views. So moving on, we will continue with our panel discussion, which will be a moderated panel discussion, wherein Shiva ma'am will be the moderator, and she'll help us with a 20 to 25-minute panel discussion, followed by a short Q&A session. Thank you.
So first of all, I want to thank each one of the speakers, both in enlightening evening we have today, and taking the concept ahead, like to start the panel discussion. I think one of the topics, the key that emerged out of the discussion was, given the credit requirement that we require for the growth to happen, as ma'am said, P2P lending, marketplace lending, a lot of, unorganized crowdfunding, trying to get that organized structure. So in this backdrop, when we're talking about capitalization of the banks, and where we are talking about, the new lenders to be on the anvil. So how do you, sir, look at the kind of funding we require for the next growth story in the sector? So what are your views on it?
Now I think, as we all alluded to, I think, also had mentioned that banks alone will not be, alone cannot meet the requirements, the credit requirements. There are a lot of other platforms coming up. She spoke about digital lending, and it's just the sheer availability of capital here, whether it's private capital that is going for funding some of these requirements. I mean, these are all some of the new things that are currently there, and NBFCs, of course, which we call the shadow banks, are there to fund the requirements. So I guess, at every level some of the other new entities stepping into meet the credit requirement. I think that is continuing.
Thank you. I think I'll also ask Ms. Capita to pitch in here. Like, what do you see, how more creative can we be on the credit side? So do you think there's a huge requirement for the credit? So we are seeing the fintech facilitating the process, but ma'am, from here, what next? Where do you see the conservative context?
So, as sir is rightly said, bank only cannot suffice the purpose. NBFC enters typical routine thing. Apart from this, huge funds will come from the mass. Probably taking go and get in the market, probably if only it can help. Nothing else. And yes, government funding will also help.
So I think I will also request. Do we need more innovative products? Like you're talking about fintech out here. So the technology, although it's going to be a big buzzword, it has been, and the kind of startups you're saying, totally agree. But you know, when you talk about that kind of culture, that the startups, the numbers that you are asking, that requires a huge amount of funding again. You know, serious funding. That every time you're making failures with the kind of solution. So from here, where do you see the funding? Again, the same question. So, ma'am,
I think every global country and the VC funds and the pension funds, wherever the money is lying relatively idle, is chasing returns. One of the, as I mentioned, that India is one of the growing economies and the largest population. The other one is China, is relatively closed. We are much better in our rule of law. There is a judicial system. There are processes around it. So we will continue receiving foreign funding in India. The foreign VCs and private equity, we will continue investing in India. There are a lot of, interestingly, the way startup ecosystem has, actually the startups are grown, the ecosystem is also grown. So there are a lot of young guys who have started their own funds. They're managing small money, they're raising capital from when we're going from $2,200 per capita income, now our rupee income is over. So at least that problem is over. So 1% of India has excess capital, which is now going back in the startup funding. My friends, good 10 to 20% of my own network is angel investment. People, NRI sitting outside of India want to invest in India. So I don't think capital will be an issue. Maybe it won't be how it was in the last 7 years because of the printing. This might not continue, and the valuation we have seen that it just takes 3 years to become a unicorn would not continue. There will be a lot of sanity that will come back to system, but when there is a good quality idea, a great team to back it, and you show some kind of execution strength, funding is there, even now. So capital formation will happen because growth is what money chases.
So, Meghna ma'am, I would like you to give your views on this. Like, we all are sitting on the wind that this capital, the discussion that's happening, that capital is but available here. But if you see the kind of need and greed we have, in order to be there, the kind of growth story that we are mapping, that appetite cannot be fulfilled by the kind of resources we want at present. So given the roadmap, the kind of fintech support that we're talking about, what do you think, where is this going to come from, the resources? So what next?
Are we talking about financial resources?
Yes, absolutely.
So, while we are all talking about the same topic, I think banks will continue to be the largest source of financing. Retail banks will continue to finance small projects, SMEs, individuals, consumer financing. I think the Bajaj Finance of the world, those kind of companies will come and rule and try and give loans to tier 2, tier 3 microfinancing companies. There are every day as we speak, every month there's a new microfinance company getting
incepted. There's a company, a friend of mine who used to work for Microsoft, and he was doing extremely well. He left and he joined a company called Suri. He became one of the founding members. So Suri is a company which does, all kinds of microfinancing loans. And they carved out a special sort of a unit which is only financing women entrepreneurs. So there is always going to be innovation on the funding side. Microfinance companies will come. HNIs, we manage HNI family money. As we see now, those guys are also saying that we are looking at interesting projects to fund. Equity to high, equity is what we are doing, but from a diversification point of view, we want interesting projects to finance. They're looking for structured financing options. They know that there are good, genuine businesses which are not getting funding from banks for whatever reasons. Banks do get a little conservative with their capital in a growing economy. So we help channelize their money into the right segments. That's another alternative source of fund that is coming into the economy. And those are the guys who are generating the employment. They are the guys who are taking the resource. They are the guys who are putting salaries in their accounts. Those are the guys who are spending that salary, increasing the GDP and the per capita income of the country. So I think it's a vicious circle. Government is cognizant. Government is also giving license to these entities to channelize finance in the right way. I think next 20 years, the challenge will not be the availability of cash. The big challenge will be to control NPAs. कितना cash होगा, कितना sector में जाएगा, NPA कैसे control करेंगे? And today morning I read the newspaper, Brickworks was cancelled as a rating agency because they were not controlling the rating agencies, figuring out the credibility of companies well. We need good rating agencies to figure out who is capable of taking a loan, who will default, who will do what. That's the need of the hour today, as much as the need for finances. And I think resources are plenty. India is a growing economy. We have money. NRI is also putting a lot of money in India. By the way, we handle such NRI deposits. HSBC is one of the largest NRI partners in India for NRI money. The amount of money NRIs put into India is not funny because India also wants NRI dollar deposits, so they give them a lot of stocks. And that is also a source of financing. NRI every single paisa retail lending mein jata hai. So I think sources are multiple. Channelizing them into the right segment is important. Microfinance and NBFCs are doing a great job. Government is doing a great job. But NPA को manage करना in the growing economy like India. That's the next big challenge.
Thank you. So now over to Sudhanshu. Sudhanshu, if I can take the luxury or the privilege of asking Indian Adam of recent time from IIFT. Said working in HSBC and FF, we keep on discussing this part and focus on this part. What are the innovations in the product side? Although the cash is available, and as ma'am said, if the NPAs or the kind of managing the cash would be a different volume. But then I understand it's going to be the resources coming in and you're able to allocate it efficiently. So that's it, that you take care. But then when we're talking about how you are going to capitalize it, monetize it, do you think there are innovations you see on the angle, on the instrument side, on some more innovations like this? What is you see on that?
Okay. So if we talk about the lending side of how the capital has to be lent, absolutely agree. Banks have a niche segment where they will not be lending to the segment below that. They will try to control their NPA. They will try to control their ratings. They will try to choose their lending customers very, very strictly. And there's a huge segment below that, right, which is not being covered by anybody. And we have fintechs coming in. We have neobanks coming in. Absolutely right. We have a lot of startups and a lot of companies coming in, and NBFC is doing that. But the point is, again, the funds will never be a problem. The problem is, who do we fund to? And are we funding to the right people who are actually on the growth trajectory? We don't want to be funding to people who may actually exit the business in a year, who may actually still be doing non-digital transactions, even in this digital world, right? So that is where segmentation will come. It will again consolidate, I feel, in a few years' time, where this segment which the banks cannot fund will also start getting a little bit of structured lending. One of the examples which I see is of corporates who are listed, or even nascent corporates which in the last 5 years are getting listed. They have a lot of cash, a lot of extra cash. Now, what they've started doing, they started taking services of fintechs to help them lend that cash and get returns on it. So, not just banks, not just fintechs, even corporates which are completely in a different marketplace model or some B2C model are lending their cash through these channels. So, banks is not the solution in lending. Banks is only the solution in the top tier, I would say. We are very, very conservative, especially with a lot of difficulties in the last few years. And RBI imposing a lot of KYC and NPA fines on a lot of banks. NPAs have become the biggest. Keeping it less than 1.5, 1.2% has become the biggest prerogative for banks, even if they don't make money in that.
Thank you. I think the last part of the moderation discussion, the panel discussion we can have and ask Msci, we were talking about, I think one or two, also talked about the valuation of the assets. So the all that you're talking about, you guys are managing such huge assets. Like given this backdrop, when you talk about companies like Paytm which get listed or say Zomato to get listed and then they erode the value overnight. So when you say valuations and when you say, okay, this kind of money, all the value eroded, you lost. So that money gone, dissipated. So, with this backdrop, I would like you to just give 1 or 2, 3 advisories or to sum up the session. What would you like to say? What is the roadmap ahead? What are the key things that I should look at so that my valuations are intact? Resources keep on coming in and I'm on the growth roadmap.
You asked me a very good question.
While I still haven't, I keep pondering on this. I still don't have a clear answer. So I think the risk capital, which coming from VC funds, where they anyways take into consideration that there would be only 10 to 20%, 10% companies actually would be outperformers, and they will give 50x, 100x kind of return. Goods 50-60% companies would be average. They just return the capital and maybe a very listed market kind of return. And the balance would die. Their cost of capital broadly in US market is 1%, 2%. And they really make their money from that 10-20%, the kind of IRRs they chase. So Paytm and these listed plays, my advice is that they have hit the ceiling where they cannot raise further capital from anywhere. So they hit the retail market. Retail market has no clue. All the fancies of branding that they are good. So they have disrupted the market. I have huge respect for that. How Paytm is a second word of for wallets, right? Today you want to do digital payment. First thing you say Paytm hai, you don't say the wallet wallets accept digital payment accept. It's not like that. So they have really changed this market and increased the adoption even in tier 3, tier 4, tier 5, whatever. However, as an investor, we'll go back to traditional ways of investing. Is the company having positive cash flows? They are PAT level profitable? And the company is throwing cash, that where I as a shareholder make money. That's what we need to be very careful of. Like, I should not comment, but there are a lot of companies in tech where I do not see a clear business model. How will they make money? UPI is being a great disruptor, but however, businesses are losing money in that. Today it is available for free, but a tech company is spending money on infra, on techies, which is a very high cost resource. So how long will this continue? And as a shareholder, it's a completely different cost. Risk capital from VCs and private equity is a very different business vis-a-vis the retail investor. So be very careful from what you invest. the company needs to make money. Simple. Nothing is sustainable without that.
you. So over to ma'am, what are your key takeaways, ma'am, as an advice to you from the discussion? Like, what the road for the roadmap ahead? What are the key takeaways?
So key takeaways, investors, still I continue the
Same thing, ma'am.
What are the key takeaways for the India growth story next 20 years?
Okay, India, oh, I thought I. Okay, so according to me, future of India is definitely bright, no doubt about it. India is going to perform. India has a lots of scope to develop further areas, say for example, certain industry, fintech, then healthcare, all these lots of other industries are also there. India is going to grow. Many other industries we have not yet identified. Probably if you go back, say 25 years back, maybe 96, 97, have you thought of what we are doing it now? No. The same thing can happen probably right now. We are trying to visualize the way we are behind. We can always identify how we will future because the route is the same. So probably I think we have visualized lots of things that we have not thought of 25 years back, and we are seeing, experiencing it now. Whatever we have spoken, yes, that can happen. Even much more is going to happen over a period of the next 25 years. Probably we are not able to thought of about it, think of about it. That's what I think.
Thank you. Yeah. See, Meghna.
Takeaway from India.
Yes.
I think this is the place to be. I don't think students need to go outside and study. I think all the colleges will come here and set up shop for all you guys. So every economy outside is getting very intrusive. You know, they want the jobs to stay within their own local people. This is a college. Students are aspiring to study, get jobs. I think India will be the place for employment, for salary generation, for consumption, for everything. Every economy wants to, every company wants to set up shop here, whether it is in IT service sector, it is manufacturing, it is consumption of goods, everything. They want to set up shop, including colleges, and also anybody needs to go out at all, you know. We want forex to come into India. We don't want our money to go outside. You know, it's just the opposite that's happening right now. And I think 20 years down the line, India should be, you know, on the trade side, we should be positive and we should not be deficit in our balance sheet. I think IT service export is a massive focus for the government. I think they will continue to do that. That will get foreign exchange into the country. We are at 540 billion forex reserves. We should surpass. At one time, it was 800 billion. Actually, we should surpass or come close to those levels. What else? I think employment-wise, GDP-wise, I think we should be the next 20 years. We should be our next. Absolutely. I don't think any of these guys need to go outside looking for a job.
Only the money we need for that.
No, for that, we just need the government to be a little cognizant. You know, today everybody is opening, setting up the shop outside, but the government is also very equally smart. We are understanding that there is a tax arbitrage there that exists, and they're going to close that loophole very soon. You know, it's just a matter of fact. As bankers, we have trouble figuring out how those guys are going to be getting the gains there. You know, and they haven't. I mean, there is a clear tax arbitrage which the government is aware of, and that's just waiting to be closed very soon.
I think there's one more thing which needs to be setting a company outside.
That's our judicial system. If there is any kind of disagreement today, resolving that is a Herculean task. It takes you keep fighting. So unless we solve this problem, rule of law, then majority. That's one of the things that if I come, okay, fine, but if there's some problem, I have nowhere to go. It doesn't resolve. So that's one thing that India needs to kind of strengthen the judicial system, make it far more efficient. The cases cannot go for 5 years.
I think we are on the way.
We are on the way.
We are on the way.
I agree.
The certain
But yet far.
Yeah, very far, but maybe next 5 years probably picture will change drastically. One good point has been that at least the global arbitrage, your, you know, Digi has been able to file and others have been able to file. So your views, the last part of it is.
Ma'am, I will refer to that one slide of ours where we said crystal gazing, and barring US and China, which will interchange or swap places, so we are expected to be the third biggest economy 30 years down the line. So why would you not want to be here rather than go anywhere else? The startup ecosystem is amazing. So there is just no reason to step outside India. Of course, if you want to go and study abroad, do that, but please come back to India and work here.
So even now salaries are catching.
Totally.
It's as good as going abroad.
No, I'm saying if you want to study abroad, you study abroad, but come back and work in India.
No, and I would support this one that everyone wants to set up shop in India. I mean, the education institute is even better.
Okay, I think the panel and the forum is open for Q&As, and anybody, the one who asked first, raise your hands, please. So who's going to ask? I'm pretty sure you have queries, or we answered all. Yes, sir.
So you are 26 or 25 or 22. Say it loud. Not shy. No, I mean, it's young blood, so.
Good evening to the panel members. So as the panel discussed that banks are the major source of finance, and this has led to the rising problem of NPA and asset liability mismatch. Well, on the other hand, we see that the Indian bond market is pretty small, and majority of it is dominated by the government bonds, which is over 90% of it, and the remaining is by the corporate bonds. So what steps can we take for having a vibrant corporate bond market so as to attract more FIIs inflows?
First is to have a platform and encourage retail participation in debt. At this point of time, I would say that 90 to 95% of the trades are done between institutions, whether they are banks, whether they are provident funds, whether they are insurance companies, or they are bank treasuries, or corporate treasuries. It's all an institutional, I would say, players. So RBI has over the last 10 to 15 years tried to deepen the bond market, but so far they have been unsuccessful. Last year we started retail investment in government securities. RBI opened a platform on its own website, but that again has not taken, and that has not found too many takers. So I think one, the understanding of how the fixed income market works, especially when you are investing in government securities as an individual investor, to understand what the credit risk, which is none, but more importantly, interest rate risk is extremely important. So unless this has to be driven by the Reserve Bank of India, and frankly speaking, they haven't done enough on this front. Does it answer your question?
Yes.
I would like to add one more thing. Probably ticket sizes matters. The moment if you go take it into retail, probably ticket size is important. Another thing is regulation. Still, I think it is not so regulated market. People are not very much confident for this fixed income market.
No, ma'am, that's not the case. One, the minimum investment to invest in government securities with the RBI platform is 10,000 rupees.
Only government securities, other public bonds and other things is expensive.
You should start with that first, because that's the most easiest thing to do. And the second is, as far as the convenience and everything, government securities are the only instrument. Government securities are the only instrument where TDS does not happen. Otherwise, for everything else, tax is deductible source. So to that extent, the Reserve Bank has made it very convenient. However, they need to push it, and I don't think enough has been done to deepen the bond market in India. And unless and until that happens, this will continue to be dominated by institutional players.
So I am referring corporate bonds.
Sure.
So my concern was related mainly not only government bond, this fixed income market includes corporate bonds.
Corporate bonds, if you see that there are a lot of
issues that come out, for example, Edelweiss has to raise money or any other entity. I mean, they come out with the issue, and it's open to individual to invest in that. So that's already there, but I think, as you said, that most of the market is dominated by government securities. So the starting point for the retail investor to invest in fixed income is that.
Thank you. Any more questions? Yes.
So my question was, recently JP Morgan held off including the Indian government bonds to the global index. So it would have implications on the capital inflow to the country. So I just wanted to understand those implications and how the government can play the role to improve it, and maybe it gets included in the next couple of years.
The biggest pain point for institutional investors to invest in the Indian bond market is the withholding tax. I think it's 5% or 10%. It's been a long-standing demand. There's been a long-standing demand of the FIIs to remove the withholding tax. Unless and until that is removed, I don't think we're going to be included in the bond indices. And so far, there is absolutely no signal or no intention from the government to take away the withholding tax.
Next. Yeah.
Good evening. So my question is down the line after 10 years, in your respective sectors, what exactly do you see the gaps of? For example, to take fintech after 10 years of going forward, where do you see the gaps would emerge and how to rectify it?
Oh, very difficult question. We don't even know the gaps next 6 months. We are fintech. We are so agile that gaps come.
And we can't foresee what's the gap.
So I don't see 10 years. 10 years ahead, genuinely we can't foresee that what will happen. So see, fintech works on the edge of innovation, almost at the edge of regulation as well. So for instance, there was this company Slice, right? There is this company Slice. They went organic growth to crazy level. So many 25 lakh or so many cars they did, and it was a name in the market. Prepaid cards. Regulation came, digital lending guidelines, you cannot have prepaid service card. Model change. So majority of the gaps is where fintech is thinking that this is the area where I see there are already champions which are like banks, big guys, right? Have access to RBI, have access to every damn resource in the country. Fintech is a new guy who's a techie. Broadly, if you check, majority of the founders are not bankers. They have no background on banking. All they understand is that this should have been more convenient and solve this. When you're solving that problem, you're almost working on sometimes edge of regulation, like digital lending guidelines. Digital lending grew for last 3-4 years, and there's so many startups which came up. RBI came up with digital lending guidelines just 2 months back or a month back, and now all the businesses are adjusting their models as per the digital lending. The guidelines is what tells us where the gap and we fix it.
Yeah, just to add to that point, on the banking front, again, even we don't know where we will be, what are the gaps for the next 10 years. But I think banking technology is a big gap which I see for the future. Banks in India are trying to do what is not their forte. They've just started to realize that they should be integrating with MobiQuicks of the world and helping and taking their help to solve their fintech problem, to solve their
internet payment gateways talking to solve their API banking problem, where the client's SAP or an Oracle or an Vision is connected to the bank. A bank should not be getting to do that because this is not their forte, and the whole system of bank is again built on technologies which are 20-25 years old. So you can't change the core banking system suddenly. Now you need to take help from these companies, fintech of the world, to make the problem that she mentioned, that the customer wants his solution to be streamlined, right? That's what we should be providing to the company.
So you're absolutely right. It's now about collaboration. Now, fintech understands that they cannot survive. There has to be, you cannot replace the original banking system, and vice versa. They realize that they cannot build this kind of a technology. I don't know if you've seen certain neobank or certain apps. The kind of work you see, the kind of engagement they have, banks are far, but they cannot. Their DNA is not that. So the collaboration is the only way forward, which I think everyone has started working on now. Even in credit market, by the way, co-branded cards is going to be the next big thing. Samsung has recently launched Access co-branded card. Vistara has launched an Access Vistara card. Co-branding, like I have a product which is bought by Access. When I go and collaborate with the bank and launch a new credit card. So that's also one of the big, that's one of the trends in digital lending these days. While we're talking about credit and financial inclusion and all of that, I just, to add on a little bit to what we are discussing, PSU banks, like State Bank of India, is the big daddy of the economy, right? If they want, they can change the face of the economy. They just need to rise up to the occasion. By the way, a State Bank of India has the best internet services that you can have. Not many of you would have an SBI account, but if you choose to, the internet banking service is fantastic. They have a lot of deposits which are just lying dormant, not attended to. The owners are sitting all over the world. They don't even know they have a revenue in SBI. That's just money sitting with them. If SBI wants, they can change the face of the credit rating of the country. SBI has cards. If they choose to focus on cards, that can be the best cards in the country. If they have SBI insurance, if they choose to focus on that, it's banks like them, the PSU banks, which need to rise to the occasion and figure out a way to provide retail credit, because the amount of branch network they have, the tier 2, tier 3 they have. Today, the ICICI banks, HDFC banks are not interested in opening so many branches. Call Karega अपना investment land लगाओ, labor लगाओ, rent दो. Who's interested? The PSUs are there. They need to wake up to the occasion and do something about it, and the government just needs to talk to them. The RBI needs to talk to them about it. That's a huge source of credit to the space which is not financed and still gets money from money lenders at a very, very expensive rate, completely tortured by them.
So adding on one segment which I missed in fintech is B2B SaaS. If you have certain softwares where you go and plug into a bank and you automatically digitize, there are lots of things like they don't have. See, you don't have that data accessible to analyze and then come up with a solution. Problem is that they have a lot of things, but that is not readily consumable by the bank. So one interesting segment is B2B SaaS in the fintech, which like Just Pay or many others payment gateways are.
I would like to take this opportunity to thank all our guests. I do believe we had a very diverse set of guests and expertise and views for our panel discussion today. Rohit sir and Meghna ma'am, thank you so much for your data-driven approach as to why India has outperformed the market and how EMs will lead the growth. Capita ma'am, thank you so much for
showing us how investing in EMs will be a delicate balance between the risk and rewards. Ayara ma'am, you bring in a fintech-based perspective and showed us how BNPL, neobanking, wealth tech will sort of shape India's finance. And of course, Sudhanshu sir, you bring in the transaction side of things and your view that not only credit is important, but also how it's important to invest in the correct places for growth. And of course, Shiva ma'am, you set the tone for the discussion with the vision of a $10 trillion economy, India, and how India's, how we as the youth can envision India at 100. So thank you so much for honoring us with your presence, and the discussion took a very diverse turn as to how alternative sources of credit funding will take place. Yeah, once again, I would like to take this opportunity and thank you for a very successful panel discussion. We have a small token of appreciation for all our guests here.
Thank you.
Thank you guys for being a great audience.
Thank you very much.
Ma'am, we can take a picture with all of them.
Sure. Thank you.
Yes.
Thanks. Thanks. Bye.
Thank you. Students, everyone,